Hello everybody and welcome back. This is Swati Gupta, Chartered Accountant. Today we are going to study International Accounting Standard 16, or you can say Indian Accounting Standard 16. Both standards can be studied together because there is no sort of curves or differences between them. The name of the standard is PPE, that is Property, Plant and Equipment. So before we move ahead, there are two announcements for you. All the standards are being recorded in both the languages, Hindi and English both. And the new videos will be released on every Friday and Saturday 6 AM early in the morning. Okay, so stay tuned, subscribe to the channel and hit the bell icon so that you don't miss with any sort of updates. Okay, so before we move ahead and see what is PPE all about, let me clear the numbering of these standards. Okay, simply there are general confusions in case. IAS 16 means Indian Accounting Standard, Ind AS 16. The numbering of IAS series and Ind AS series is exactly same. IAS 16, it is for PPE. Whereas if we talk about IFRS 16, the numbering is done in 100 plus series. Okay, to identify in Ind AS, the series is done counted in 100 plus series. That means Ind AS 116, it is for lease. Okay, so don't get confused in Ind AS 16 and Ind AS 116. Okay, we are going to talk about PPE in this lecture. So I think we're good to start. Let's begin. To begin with, let's talk about the non-applicability of Ind AS 16. Okay, that means the PPE standard will not apply on following cases. That means first, exploration and evaluation asset, it is included in Ind AS 116. Therefore, it will not be discussed in Ind AS 16. Okay, that is 16. Next comes this biological asset, will not be considered under this standard. It will be considered under Ind AS 41. That means if you have to talk about, if you have to discuss the accounting treatment of any biological asset, then you have to refer Ind AS 41. Okay, but if we talk about bearer plans, then it will be considered in PPE. This is considered in PPE. Okay, now what is bearer plant? It is simply any living plant that can be used for further production or supply of agricultural produce. Production or supply of further agricultural produce. It is expected to bear produce, that means it is expected to bear some sort of produce, that means any fruits, vegetables, cereals, etc. any produce. Okay, and that too for more than one period. Okay, and has a remote likelihood of being sold and has a market somewhere. Okay, this is known as bearer plant. Now if we talk about bearer plant is included and is discussed in standard Ind AS 16. Okay, now investment property. If any property is taken for investment purpose, then its treatment will be dealt in standard 40. Otherwise, it is dealt in standard 16. Okay. Now, the basics of PPE. There are 8 major points. We'll discuss one by one. First, meaning the PPE are tangible items. That means we can touch, see. Okay, they are present in physical forms. Tangible items held for either production of goods, supply of service, rental purpose or admin purpose. If it is for any of these 4 purposes or plus can be used for more than one accounting period, then this satisfies the PPE definition. Any item that is either for these 4 purposes and can be used for more than one accounting period, then it is considered as PPE. Now if we talk about spares, if they satisfy the PPE definition, that means it will be recorded as PPE. Otherwise, they will be recorded as inventory. This is important. If they do not satisfy the definition of PPE, then it will be considered and recorded as inventory. Okay. Now, the definition of PPE is what we have read right now. These 2 conditions. Next comes is initial recognition. This is the first time recording of such PPE in the books of accounts. It will be recognized only when both the following 2 conditions are satisfied. First, it provides future benefit. Second, the cost can be reliably measured. Then only such PPE will be recorded in the books. Okay, otherwise not. Next comes this cost of PPE depends upon the mode of acquisition. The cost on which it will be recorded in the books depends upon how it is being acquired. 4 items are there. 4 types of acquisition are there. 4 modes of acquisition are there. First comes as purchase, self-constructed, exchange and deferred payment. We'll discuss one by one each and every mode of acquisition. Okay, but mode of acquisition are 4 and the cost depends upon the mode of acquisition. First we'll talk about the purchased PPE. The purchased PPE, like in case if you have read the Ind AS on inventory, there also the raw material costing, the WIP finished goods, there were items that will be included in the cost while recording in the books of accounts. Similarly, here also there are items listed which will be included in the cost if it is purchased PPE, that means property, plant or equipment. Now, purchase price paid will be included. Secondly, carriage and freight. Next comes as non-refundable taxes. That means any tax that has been paid and will not get any sort of set off, input, refund, none is available, then these taxes are known as non-refundable taxes and it becomes a part of cost. It is included in the cost and therefore non-refundable taxes are included in purchased PPE cost. Next comes employee benefit cost or expense. That is directly attributable, very important. Means, for example, if you are in a position to buy a machinery and you choose to buy a machinery, okay, and for that you have an employee which is an engineer expertise, okay, which have an engineer expertise and you wish to appoint him, okay, he does that work. Such cost that you have paid to him, such amount that you have paid to him is directly attributable to the purchase of that machine, okay, therefore that cost will be included in this cost of PPE. Now next comes as installation cost. Any cost of installation, that is bringing it to the premise and putting it into a working condition, is known as installation. That will be added. Next comes trial and run expenses. Okay, there are at times expenses which are done, which are carried out because of trial and run. Okay, before becoming the premise, the PPE operative and making out very right products, okay, there comes any defective products, okay, some trial products. Those products are also included in the expense, in the cost of that purchased PPE, but after deducting any recovery, okay, for example, there were 50 items that were scrapped, okay, that were defected and they were scrapped, okay, so you received some amount that will be deducted from the trial and error expense and then such expense will be included in the cost of PPE. Next comes borrowing cost. This will be included as per the Ind AS 23, as per the limits that they permit. And next comes decommission and restoration liability. This will be done at PV, that is present value, estimated present value. What is decommissioning and restoration? At times the entities have some liabilities, some obligations to restore that environment, to dismantle that PPE after the use has been done. So since it has obligation right from beginning, before installation also it had some obligation, so such obligation cost is directly related to the PPE, therefore such obligation of decommissioning or restoration is included in the cost of PPE and it is included in the PV form, okay, that is present value price. Next comes the self-constructed PPE. There were 4. Now we have talked about purchased PPE. Now we are talking about the self-constructed PPE. Actual cost of material. See, underline actual cost of labor, actual cost of overhead, installation cost, trial and run expenses, borrowing cost and decommissioning. These are all same. Here instead of paying the purchase cost and the carriage freight, okay, here what it is the specific labor, material and overheads that you have put in the actual cost at actual cost level. Next comes the costs that will never ever form part of PPE. Those are first abnormal cost. Any abnormal costs are directly transferred to PL, that is P&L account. Preliminary expenses, pre-opening expenses, pre-operative expenses, advertisement, selling and distribution, administration expense, etc. These all expenses will be directly taken to the P&L and will not be included in the cost of PPE. Next, PPE acquired under deferred payment. If PPE is acquired on some loans, some EMIs and all, okay, then very importantly, it will be included in the, it will be recorded in balance sheet, it will be recorded in books of account on cash price. What is cash price? The cash price is the amount that you have paid if it was not taken on EMI. For example, you buy a PPE at rupees 10 lakh, okay, and since you have taken it on EMIs and on loan, okay, you will be repaying it in next 10 years, okay. So the amount that you will pay in next 10 years is approximately 15 lakh. The amount gap of 5 lakh, this 5 lakh is this is simply the interest amount, okay. This is the amount that you are paying because you have taken the benefit of deferment. Otherwise the purchase cost is what? 10 lakh. This 10 lakh, the upfront amount, the main amount, is known as cash price, okay. The amount without any interest and all is known as cash price. So the asset that has been taken, the PPEs that has been taken on deferred payment will be recorded on the initial price, on the cash price, and the later interest portion difference will be taken to the P&L. Next comes as exchange asset, okay. Here we have discussed about four mode of acquisition. We have discussed about purchase, self-constructed and deferred payment. Now we will discuss about what? Exchange asset. Exchange asset is what? Is acquired by transfer of any other asset. Is acquired by transfer of any other asset. Now this PPE, the other asset may be any other asset, another PPE, or any asset of different nature. Okay, when you are acquiring any PPE by exchanging, by giving in return, by paying any other asset, this is known as exchange of asset. Now, in case acquired PPE are recorded at fair value, this acquired PPE is always recorded at fair value. This is important. Okay, this is recorded at fair value. In case of exchange, it is recorded at fair value. In case of for example, in case of deferred payment, it was recorded at cash price. If asset has no commercial substance, then acquired PPE is recorded at the carrying value of the asset given. Okay. Next, what is commercial substance? Commercial substance is just the difference of any risk, timing or amount. Configuration should be different. For example, if you exchange any 2 pens, okay, they are identical, they are of same price, they are of same company, they have the same amount of refill in it, okay, the same amount of ink in it, those 2 pens are identical. So if you exchange it, will not be considered as exchange asset. If 2 identical assets are exchanged, those have no commercial substance. Since it has no commercial substance, then it will be recorded at the amount of the given asset. Okay, and if it has commercial substance, then it will be recorded at fair value. Okay, when due to acquired asset, value of business should change, or either there should be configuration change or value of business change. What is configuration? Risk, time or amount, either of it should be different. Okay. Next comes is repair and replacement. In case of repair, if it is general, it is directly transferred to P&L. Whereas if it is periodic, that means AMC. For example, you have taken AMC of any machine. For example, annual maintenance contract for 3 years. Okay, of rupees 3 lakh. Then this amount will be written off in P&L on SLM basis over the 3 years. That means over 3 years, 1 lakh will be transferred to P&L every year. Okay, if it is periodic, then it will be divided upon SLM basis and will be transferred to P&L over the period of such contract, and if it is general, it will be transferred to P&L directly. Whereas if we come to replacement means Whereas if we come to replacement is simply what? Giving up the old asset and taking the new asset. So the cost of new replacement part will be added, whereas the amount that you will receive, the WDV of old replacement part, will be deducted. Okay. Next comes as subsequent accounting, the accounting that is done henceforth. Okay, after initial recognition. There are 2 models, either cost model or revaluation model. There are 2 models, either cost model or revaluation model. Firstly, it is a choice. Okay, it is a choice. If you opt for revaluation or cost model, this is a choice for the entity. It can opt for either of it. Cost model records historical cost minus accumulated depreciation minus accumulated impairment. The depreciation till now, the impairment till now. Whereas revaluation model records at fair value minus subsequent accumulated depreciation minus subsequent accumulated impairment. Okay. Now what comes is, here it is always applied class by class. Similar to income tax and all, you have different classes of assets, plant and machinery, land and building, furniture. Okay. Here also it will be done on class by class basis, that is plant and machinery, furniture, land and building, bearer plant, etc. Now cost and revaluation model can be selected only at the time of initial recognition, very important. Selected only at the time of initial recognition and cannot be changed subsequently. On subsequent accounting, it cannot be changed. The option can be opted only at the time of initial recognition, and the option that the entity chooses has to be followed consistently. It cannot change afterwards. Okay, this is very important. You can have questions on this. You can have interview questions or MCQ questions on this. Now fair value will be determined according to Ind AS 113, that is fair value measurement. I have recorded the standard in English and Hindi, both the language. Okay, it is available on the channel. If you really want to study the fair value measurement standard, you can definitely check out. It is the link is given in the description also if you want. Also, if you need any notes of this standard or any other standard, you can check out the description box. The link is given. You can download the notes easily. Okay, moving ahead, the fair value measurement standard prescribes and guides how to calculate the fair value measurement. Okay, how to calculate the fair value. Whereas, when to calculate the fair value is given in the respective standard. So, if the Ind AS 16, if Ind AS 16 asks that you have to value PPE at fair value under revaluation model, then such fair valuation will be done as per the Ind AS 113. When to be done is prescribed by that particular standard, and how that value will be done, how that valuation will be done is given under standard 113. Okay, so what here it is written? Fair value under revaluation model will be determined according to the Ind AS 113, that is fair value measurement. I hope this is pretty clear. In case if you have any doubt, please comment down below. I will definitely try to answer them as soon as possible. Next comes is accounting of revaluation model. This is super important. Okay, super important. Now what if you have chosen the revaluation model? What happens is, either on the first time revaluation, either you will up value or down value. Simple. Either you will up value it or down value it. If you have up valued, then the amount that is extra will be transferred, will be credited to revaluation surplus. Okay. For example, the PPE was up valued with rupees 2 lakh. So such amount will be credited to revaluation surplus 2 lakh. Okay. This is OCI. This is what? OCI. Other comprehensive income. We have studied 9 items in OCI. We have studied 9 items in OCI. So this item is one of the item in OCI. Okay. Revaluation model. Upward valuation on revaluation model, under revaluation model. Okay, this is clear. Now if you down value on the first time, what happens is the amount that is downward valued is transferred to P&L. For example, if you take the PPE on the first time revaluation was devalued, was downward valued for rupees 2 lakh. P&L will be debited and the PPE will be credited, will be deducted, will be lowered by 2 lakh rupees. Okay, it's fine. Now if we come to second and subsequent revaluation, okay, this is what? Second and subsequent revaluation. For example, after upward, even on the second time it gets upward revalued, means the increase in value. For example, 3,50,000. Okay, now the upward value is 3,50,000. So 2 lakh was revalued before only, and now 1,50,000 will be revalued. Okay, 1,50,000 more. And it is again taken to revaluation surplus, that is OCI item. Okay, here if it is downward valued, okay, in case after up valuation it is downward valued, for example 3,50,000. The PPE amount is 3,50,000 downward value. This will be first charged from reval surplus. That means 2 lakh we were having revaluation surplus, we'll charge this 2 lakh. and the remaining balance in figure 1.5 lakh will be charged from P&L. Okay, always downward valuation will transfer to P&L and upward valuation will be transferred to revaluation surplus. But in case if you have revaluation surplus, it will first charge from revaluation surplus and then the amount in P&L will be charged. Similarly, from downward, if you again go for downward, even if your amount, okay, if your PPE has been devalued again, okay, let me do it, wait. Okay, I hope this is clear. After downward value, it is again downward value. For example, if you take for example here also, it is again downward value. Then the amount will be P&L will be again debited and the PP amount will be again debited. The same entry will happen. Whereas if you go for up value, okay, if you go for up value, then what happens? The PPE will be debited, okay, by that amount, for example 3,50,000, and then the reval reserve, then the P&L will be again credited back, okay, 2 lakh it was done before, it will be reversed and the balance in figure will be taken to revaluation surplus. Okay, the balance, for example the PPE is upward valued 3,50,000. Okay, so before we had P&L debited, we will reverse that firstly, that is 2 lakh, and the balance figure 1,50,000 will be taken to reval reserve. This is again OCI item and this will be taken to 1,50,000. I hope I am clear. Okay, in case of any doubt, please comment, please ask. Okay, next comes is depreciation. Also PPE standard talks about depreciation. These are very minor things. Let's take a quick review. Depreciation is a systematic allocation of depreciation amount over the useful life. Here in the standard, the term that has been used is useful life. Useful life means expected number of years during which the expected asset is expected to be used. The number of years for which the asset is expected to be used. Okay, it never means the economic life, not the beneficial life, only the life for it will be used. Depreciable amount means will be calculated cost upon revalued figure minus residual value minus scrap value. Next, residual value means expected realization at the end of useful life, okay, the scrap value. Depreciation starts when the asset becomes ready for use, this is important, and it stops when it becomes out of use. Method of depreciation allowed is SLM, that is straight line, WDV, that is written down value, and production unit method. These all three methods are allowed under the PPE standard, that is Ind AS 16. For calculation of useful life, calculation using principles of Ind AS, either this or use the Schedule of Companies Act. For using the useful life, you have to take what? Either the Ind AS 16 that have been given, otherwise you can take the schedule from Companies Act. Next comes component approach. That means, for example, you have some compound asset, that means land and building. So land is never depreciable, you have to record it separately, and your building also you have to record it separately. You have to depreciate only building and land will not be depreciated. Identify the significant component with different useful life, calculate useful life, depreciate each component separately. Depreciate each component separately. For example, land is not depreciable, hence in case of land and building, land is separate component and shall be accounted separately and no depreciation will be charged. Also, in case if you have held PPE for investment purpose, it will be referred with Ind AS 40. Here, if you have kept the PPE for sale, then Ind AS 105. If impairment of PPE happens, then you have to refer Ind AS 36. If PPE is under lease, then you have to refer Ind AS 116. Okay, otherwise not. PPE only for that production, supply, administration, rental purpose is included here and considered here. Next, disclosure requirements. You have to disclose accounting policy, the gross amount, accumulated depreciation, depreciation policy, rates, useful life, and method of depreciation that has been followed. Also reconciliation, that means what was the opening balance, what any addition, deletion from the PPE, and then the closing amount. Lastly comes as estimated liability of restoration and decommissioning, the amount that was obligation, you have to take the estimated PV of it and you have to disclose it in the disclosures. Also any other required disclosures if any. Next comes is estimated liability for restoration and commissioning. Decommissioning and restoration simply means any obligation that sometimes entities have to dismantle, remove or restore the items of PPE. Such cost for restoration of environment is known as decommissioning cost. This cost, if it has discount portion, okay, if it changes because of interest amount, then it is simply transferred to P&L. If it changes because of any other factor, then check if it is cost model or evaluation model. The PPE initially was recorded on cost model or evaluation model. If cost model, it is adjusted from cost. If revaluation model, it is adjusted from fair value. You know, in revaluation model, you have to record the PPE at fair value, whereas your cost. So under cost model, you have to adjust the cost, whereas revaluation model, you have to adjust the fair value. Okay, I hope the standard is very much clear to you. In case of any doubts, you can definitely ask me. Also, if you like the video, please do hit the thumbs up button and comment me in case if you like or dislike anything. Okay, see you in the next lecture. Till then, take care, be safe, stay tuned.